Hola, buenos días a todos. Continuaremos con el programa de esta convención del sector asegurador y vamos a hablar de una parte fundamental y muy interesante que es la distribución de seguros. Para ello se encuentra con nosotros Sean O'Neill, que es socio de la práctica de servicios financieros globales de Bain Company y se desempeña como líder del sector global de seguros. Sean cuenta con 30 años de experiencia en consultoría de servicios financieros en las áreas de estrategia corporativa, de negocios, operaciones, de distribución y marketing y mejora del rendimiento. En materia de seguros tiene amplia experiencia en procesos de suscripción, reclamaciones y gestión de productos. Sean también forma parte de la práctica de fusiones y adquisiciones de Bain, donde su trabajo se ha centrado en el desarrollo de nuevas empresas y alianzas estratégicas, evaluación de adquisiciones e integración de fusiones. Sean también trabaja con patrocinadores financieros en diligencias y transacciones relacionadas con seguros. Sean se graduó en Economía con honores de la Universidad de Villanova y tiene un MBA de la Universidad de Chicago. Welcome, Sean, to Mexico to that conference, and please go ahead.
Thank you, and good afternoon. And first, thank you for the opportunity to meet with you, albeit virtually over video. I think I was introduced perfectly, although I could not understand all of it. But I've spent 30 years consulting to the financial services sector, and I currently lead the global insurance practice at Bain Company. And so today I want to share some brief thoughts on the future of distribution in our industry. But before diving in, I wanted to put the distribution question in a slightly bigger and broader context. So could we turn the page, please? So this is a busy slide. It is a busy slide by design. It captures basically 175 years of events that basically highlight a turbulent world, a world that we actually believe at Bain & Company is becoming more turbulent with just the frequency of events that you see on the right-hand side of this chart. The bottom line is that the world is becoming riskier, it's more complex, it's more interconnected. Risk is coming from known perils like weather, which is becoming unpredictable in and of itself, and coming from unknown perils like the pandemic, the geopolitical uncertainty that we have, shifting macroeconomic environments, and the list goes on. So, but regardless of the source of risk fuels uncertainty. Uncertainty creates the need for advice. And the key takeaway basically is that distribution and advice need to go hand in hand. Distribution can't be just about access. Distribution and advice need to go hand in hand. Next page, please. So in this evolving, complex world, insurance products must meet two important but slightly differing needs. On the one hand, they need to meet the needs of increased protection that consumers require in this evolving, more turbulent world. It's protection against unexpected weather, it's protection for new devices and assets, protection from new perils like cyber, protection from disrupted supply chains, and even protection in the metaverse. We have actually some clients who are trying to figure out how to think about products to insure virtual assets in a virtual world. The second thing and the second need is that insurance products and the experiences wrapped around those products need to drive greater engagement with the consumer. This could be engagement through, by leveraging usage-based insurance or UBI for more than underwriting, and for things like a driving score, possibly gamifying that experience. It could be engagement in loss prevention through sensors in the connected home, creating new experiences and services for the consumer. It could be engagement through the addition of value-added services in the core offering, whether that's access to preferred contractor networks, etc. But basically, the key takeaway is distribution, not only has to deal with this complex world that we live in and render advice, it also has to meet the emerging needs for protection and for engagement. Next page, please. So I'll spend a little bit of time on this. With that backdrop of sort of the complexity in the world and what we believe insurance products have to do, we have 5 beliefs that really shape our thinking on distribution. I'll spend some time on each of these. So that, belief number 1 is that, agents will continue to play a central role in the distribution system. We do not believe the insurance distribution system is going to become completely disintermediated with digital. We actually believe that the agent has a central role to play in the system. As I mentioned, because of the complexity in the world, advice is becoming increasingly important. Discretionary products like life and some health products are always going to be sold, not bought. And guidance is going to be required even more so to help consumers through the myriad of choices, whether that's choices in product or choices of coverages or endorsements within a product. So belief number 1, agents will continue to play a central role in the distribution system. However, our second belief is that those same agents will have to become digitally enabled themselves in order to raise their effectiveness and for efficiency reasons. What does this really mean? Well, there's many things that go into sort of the digital enablement of an agent. But if you think about marketing and prospecting, will have to become more data enabled. Leads can be enriched with local market data to increase the probability of conversion. Cross-selling processes will need to be digitally enabled. We will need to have more data to identify triggers that lead to selling processes, that lead to cross-selling processes. Next best product to buy, next best action models are all going to drive, classic cross-selling and selling processes. But again, will have to be data and digitally enabled. Behind all of this, we think that the analytics and the data can be scaled centrally and delivered locally. So while we said in belief 1 that agents are going to play a central role in the distribution system, we also fundamentally believe that these agents will have to evolve and change as well. Belief number 3 is basically that we live in an omni-channel world. We need to meet customers in the place and the time that they desire, not where we desire to sell. Basically, if they want to buy on a Saturday morning or a Sunday morning or a Monday night, if they want to buy over the phone, if they want to buy in person, if they want to start on the phone and finish on person, we need to be able to meet those needs wherever they want to be. The reality also is channel expectations are not shaped inside insurance. They're shaped with how consumers interact in their retail environments, in their banking environments, in their media environments. And so we have to be a taker and reactor of customer expectations on channels rather than a shaper in the world of insurance. And lastly, channels have to be harmonized in this omni-channel world. I use the word harmonized because I think a lot of energy goes into things like seamlessly integrating all channels of distribution in a real-time basis. We actually believe that, at least at this juncture, it is very cost prohibitive to try to have sort of real-time seamless integration of a multi-channel environment. We do think channels have to be harmonized. We do think there are points of key integration. We do think that this has to be sort of architected around customer journeys and customer episodes. But we don't think the answer to this, at least initially, is a full-scale seamless integration of all channels, at least inside the current economics of the products that we sell. So belief 3, omni-channel world, and no surprise there. Our fourth belief is that the paradigm has shifted, requiring sellers to up their game and become better at selling. We see this in all industries, and insurance is no exception. The information advantage, we believe, has shifted from the seller to the consumer. It is so much easier for the consumer to find choices, to find alternatives, to discover price, to come to the sales process equipped with an information advantage versus in times past where often the seller had the advantage. That leads to price discovery and transparency, as I said, becoming much easier, and access and choice for consumers is plentiful. So again, belief 4 is sellers will need to become better at selling. And we believe, as I said, insurance is no exception. Our fifth belief is basically that price perception and presentation are becoming increasingly sophisticated and are going to become a core capability of the industry. Our research would say that perception of a fair price is actually what matters most versus lowest price. Perceptions are shaped by how price is displayed, how price is metered, and there's a lot of science in many other industries that go into pricing strategy, pricing display, price presentation. And we believe that the insurance industry has still a lot to learn in terms of how it increases its sophistication in not necessarily pricing, which obviously I think we're pretty good at, from an actuarial perspective, but how we think about presenting price. And how do we think, if you think about the retail industry, whether it's everyday low pricing, whether you think about subscription pricing in media, or whether you think of SaaS pricing in software, there's advances in pricing, meter and display and presentation in all sorts of industries, whereas insurance is still, I think, in the very early innings of really pushing the needle on this. That all requires a test and learn environment to build this capability inside a carrier. So, like, if you think across these 5 beliefs, like at the end of the day, we see agents continuing to be a very important part of the distribution. We do see them being data and digitally enabled. We do see them having to participate in an omni-channel world. We do see them having to get better at actually their core capability of selling. And we do see price and the presentation of price being inextricably linked with distribution. So those fundamental beliefs shape a lot of what we think carriers are facing, and distribution in insurance is wrestling with over the coming years. Next page, please. So as I mentioned, distribution is facing disruption. So while and we see this from many angles across the globe, and I'll touch on a few of these, and there's 6 on this page, but there could be probably 6 others that aren't on this page. Access to new distribution channels, whether that's from insurtechs or whether that's from social. The rise of affinity and partnership distribution we're seeing, particularly with OEMs talking about embedded, for instance. The surge of insurance marketplaces, quote comparison, access to more products. We see this primarily on the B2C, but we're starting to see it on small business and small commercial. It's more dominant in some markets than others, like the UK, but it is a trend to watch. We see the consolidation of the brokerage model, access to more scale product segments. We see that primarily in the United States market, but it is a global trend. We see the shift from captive to independent agents, reflective of choice and access potentially to better pricing. And we see the change in consumer behavior that has only been amplified in COVID. When you think of remote work, online shopping, telehealth, all of these things have changed the boundary conditions for where customers are comfortable interacting digitally or virtually. And so I think that will continue to put pressure on insurance distribution. Next page, please. I won't go through this whole slide, and I'll just pick two examples, but we believe that the traditional players will continue to be squeezed by new entrants and business models, but we also believe that the traditional players have a lot to offer, and a lot to offer in terms of how to win in this market. But just looking at two examples on this page, if you look down in the left-hand corner in the OEMs in the middle of the page, Tesla. So Tesla has started offering embedded insurance with their cars in a few states in the United States. They did this originally in conjunction with a carrier, so they sort of bypassed or disintermediated distribution, but they didn't disintermediate underwriting. However, in the last few states that they just rolled out, they've actually decided to take the risk themselves. So they are on risk themselves. They believe, obviously, their data is maybe a better predictor of risk. They can price it appropriately. And so now the next generation of Tesla insurance products are not just disintermediating distribution, but also disintermediating the underwriting function and the carrier. It is way too early to tell whether this is the impact of this. Customers may lose pricing discounts if they have multiple cars that aren't all Teslas. It's unclear how bundled pricing will work with home and auto in the Tesla world. But it is an example of the power of data. In this case, data coming off the car, usage-based data, and the emergence of new competitors, either changing the paradigm for underwriting or changing the paradigm for distribution. Something maybe a little closer to home is what State Farm, Allstate, Liberty Mutual have been doing in the last couple of years. They've all taken actions to increase their presence in the independent distribution channel and move that shift from captive to independent. State Farm and Allstate did this through acquisition. State Farm buying Gainsco to get access into the independent agents and a specific segment of customers. Allstate doing the same with their acquisition of National General. So it's a little bit of a segment and a distribution play in that the independent channel is probably going after a little bit more of the substandard risk, and the captive channel that these companies own goes after the preferred. But basically now trying to figure out how those channels work in coordination is the name of the game. Liberty took a different action, and they converted 2,200 exclusive agents into its own distribution company called Comparion. Comparion's basically a new digital agency. It's going to offer, or does offer, personal auto, personal home, small business, and those agents can now offer not just Liberty Mutual insurance, but basically a range of insurances from, I think, about 50 other carriers. So again, everybody in this page is coming at this distribution question from different angles. Some people are coming at it from very strong positions in the captive channel, like a State Farm or an Allstate. Some are coming at it from the point of purchase and the OEM, and the insurtechs and others are coming at it from their own vantage points. We believe that traditional insurers have the right to win in this market, continue to have the right to win. There's a lot of things that are hard to replicate. It's hard to replicate the matching of price to risk. We're seeing that in the insurtech sectors, where many of them are struggling to scale and get profitable. And obviously the incumbent customer base and the product engines and the product development engines inside the traditional players are all assets. But we do believe that they need to sort of be leaning forward and driving into this future and can't be complacent. Next page. Thank you. So if you ask yourself, I guess, what needs to be done, we see sort of three things. We put with productivity in sort of three buckets. The first pillar is driving sort of primary sales channels to their full potential. We talked about sort of digitally and data enabling the agency. We talked about driving share of wallet through cross-sell. We talked about the optimization of the distribution channel, say through selling or commercial excellence. And we talked about the need to think through increasing customer interactions and driving greater engagement with the consumer. So first things first, insurance companies have to drive each of the channels that they have to their full potential. What's difficult is they have to work also on the second column here, which is creating complementary channels, either growing the channels that they have that are subscale or initiating new channels that they don't have today. They have to assess this disruption risk. They have to incorporate new channels into the distribution system. They have to enhance the digital channels they have, to meet not just the younger generations, but probably all generations' needs. And they need to sort of work to get the cross-sell across these platforms working when you have a multi-channel environment. And lastly, they need to do all of this with an eye towards engagement, both in the could be a customer portal for policy administration, it could be notification of claims, it could be the growth of self-service. You need to create applications on multiple devices because, as we said earlier, you've got to be where the customer wants to be. And they need to think boldly about products that can drive engagement, whether that's the UBI products for usage-based, and thinking about those not just from a pricing perspective, but an engagement perspective. And the connected home, we believe, gives an avenue for a lot of engagement. So I'll pause there and close with, we believe the distribution system is changing a lot. There's a lot of disruption, but we believe that the traditional insurance companies have absolutely the right to win and just need to be leaning forward.
Thank you, Shane. It was a very, very interesting presentation, and we have a lot of think about that. I have some questions that we got by the chat. The first of this question is, when you think all these changes in distribution, what's the most difficult shift for a traditional insurance company?
Great question, Eduardo. It's as I mentioned, there's many challenges to overcome, but I think one of the biggest I've seen is for the companies to fully embrace that the distribution model will be omni-channel. Like many companies say those words, many companies feel that they're heading in that direction, but in the reality, many of the traditional insurers are still beholden to their primary channel. They struggle to sort of move aggressively into the new channels. There's fear of disrupting what drives business today, and therefore they're slower to adopt what we believe the customer wants. Now, don't get me wrong, protecting the core channel that drives the business today is very important, but I think to fully embrace the omni-channel vision, you've got to get the balance right between sort of being internally focused and externally focused. And related to that, I think companies often struggle with really understanding the return on investment or the ROI on omnichannel. One must look at the ROI, I think, of the system and over the lifetime of the customer, which is a hard thing to do, and it's a hard thing for insurance companies that are often very product focused to sort of make that shift. But if you look at if you spend too much time looking at the ROI and individual channels and individual actions, it can sort of lead to bad decision making. What we see is you've got to be able to pull back, look at this more in its totality. But we find sometimes, like, insurance companies needing to see the proof that the omni-channel value proposition is there because of the investments that are required, and that's a continual struggle. So I think it's not because they don't see where the market is going, but they find it tough to probably invest in that direction without fully seeing the return in the short term, which I think is actually hard to accomplish. And related to that is also, I think, just this mindset that this game is never over, and probably the only constant is change, and therefore, as soon as you think that you've sort of reached an omni-channel world, there's probably another channel out there, there's probably another customer need. So I think it's like really trying to embrace what omni-channel really is and what it takes to get there is probably the most common difficult shift I see.
Thank you, Sean. Another question that I have is how you anticipate the timing and inflection points on the shift in distribution.
That is not an easy question to answer. But a couple of thoughts. I think where we've seen companies do this maybe better than others are companies that have set up a set of key indicators or signposts to watch them on a consistent basis. Many of these sort of signposts or pieces of data center on various evolving customer needs, competitor moves, trends from other industries. But I think the value is having a consistent set of signposts where you can actually see the longitudinal view, you can see the trend, you can start to separate the signal from the noise. And I think too often companies probably struggle with, like, what's the right thing to measure, and they keep changing things, and so they never get a longitudinal view. So we have some clients that do spend time tracking things like how many hours certain segments are spending on screen time, what does rideshare penetration look like in various geographies that triggers sort of driving behavior, what's been the recent penetration of telehealth appointments, which increase comfort with virtual interactions. And I think what we see probably more than the more successful companies is trying to sort of get those signposts and then have the discipline to continually be watching them, even though some of them move at very slow speeds. But to pick up an inflection point, you have to sort of be able to sort of separate as I said, the signal from the noise. The other thing that I think is related to this or helpful in this is to sort of take a scenario planning approach. You can't predict with certainty direction or pace of direction, and therefore I think posing questions like, how well are you prepared if auto became a fully digitally sold product in 3 years? Could you shift to meet that market or not? How well are you positioned to sort of play in the referral or the review networks if that becomes a major influencer channel and how customers think about getting advice? Or how quickly can you adjust price or a product feature if the market demands that? Could you do that in 6 months? And so sometimes I think forcing, scenario questions into the planning process is a way to sort of test readiness for different inflection points without actually forecasting inflection points. I think it's a little bit like forecasting the weather, but I think you have to be prepared for various outcomes. So the combination of signposting and the combination of scenario planning, I think, are two potential ways to start anticipating this maybe a little better.
Okay, and another question, in your opinion, what should be the stance of a traditional insurance company, being a disruptor or a follower?
Another great question. It's I think the answer is probably both. I think insurance company, traditional players have to be prepared to disrupt themselves. This requires them to build new capabilities and determine when's the right time to shift energy, investment, capital, resources to those new capabilities, and it's a very difficult act. Like, even if you take something like direct and agency, which have been together for a long time, companies do deliver both, but they've often built the direct channel outside of the agency construct. They've often, in certain markets, branded it differently, put it on different infrastructures. They've built it nearly as an engine 2 capability. Some people have gone out and bought it, like Allstate did many years ago with Esurance. But one of the hardest acts, I think, is then, like, if you sort of build that, if you're trying to disrupt yourself and you build that outside the core business, how do you sort of bring it back in? How do you bring even the lessons learned or the capabilities back into the core business is a very, very difficult act. And either what we have seen is it's often brought in too early and then the core business sort of kills it because it wasn't mature enough, or it's kept outside for too long and it becomes too separate and can never be brought in. And so I think, the challenge with sort of the, should you disrupt, be a disruptor or follower, is there's just not a lot of binary decisions. There's a lot of multivariate decisions in this, in this distribution world and even the insurance world more broadly. And so I think, it's really, at the end of the day, it comes down to sort of managing the trade-offs. Often, trade-offs are basically the art of strategy, and I don't think distribution is any exception. So, it's probably a little bit of a non-answer that they have to be both, but I do think that probably is probably the right answer, because it's going to take the mindset to be prepared to disrupt yourself, but at the same time, recognizing that you probably don't want to get out, you don't want to get out in front of that, and there's a time and a place. So that would be my thought on that one.
Thank you very much, Sean. The time is over, and I appreciate that you share with all that comments and your opinions, and it's very, very important for us, in this market, in the Mexican market. We appreciate you. A todos ustedes me despido, les agradezco mucho su participación en este momento de la Convención Nacional de Aseguradores, en esta interesante plática, y pues nos estamos viendo y espero que continúen con nosotros durante todos los eventos de la Convención de Aseguradores. Muchas gracias.
Thank you.